and roll, just partly because a few other people will jump on, and then I mean, really, the meat of the matter is just going over the numbers and more or less really trying to figure out how we correlate that into conversations with the clients that we're having on a daily basis. So, I mean, what is it? How do we make sense of all of the information that's out there? How do we turn that into substantive contact with the people that we're doing business with? How do we be the voice of reason right now when there's so much gobbledygook? What do we make sense of it with, right? And so really, I want to start with a couple of different key metrics, top level. One is, let's start talking about how we have a conversation about recovery, which is what we've been talking about for God knows how long. Then how we talk about the current employment situation, and then how does that parry into real estate conversations. So every drum roll, please, everyone's favorite time when I figure out how to share my screen. And there we are. All right. So, yeah, we're talking about recovery and really what it looks like, what many economists, what many very, very influential financial institutions are contemplating right now is, when do we start to recover? And there's a lot of talk that's bantered around about shapes, this, that, and the other. What I'm really thinking how this is going to really play out is that it's going to be more along the lines of, we're down somewhere close to the bottom. If we're not already damn near dead stock at the bottom, we're pretty close, right? So now what the economy is going to do, since we're gradually opening things back up, I think that the numbers are going to kind of bounce along the bottom for a little while. They're going to go up a little, down a little, up a little, up a little. We're not going to see some comet take off into the sky, but we're also not going to flatline. And what that really means is, what really is going to go on. And I don't really know what will, because again, this is uncharted territory for everyone involved, not just people that haven't been through several different recovery and crash cycles. This is completely different than ever. But what everyone seems to agree on is that the shape of that is not going to be the bad boy, the big ugly that happened in 2008, which was an L shape where everything went down, stopped, and we just rode along the bottom for close to 5 years. So what does that mean? Well, one of the chief economists at Freddie Mac had one of the most poignant things to say about the topic, and it's, although the uncertainty of the crisis means forecasts of economic activity are more unclear than usual, we expect that most of the economic damage from the virus will be contained to the first half of the year. Going forward, we should see a recovery starting in the second half of 2020. Now, I know that's broad, but it is really simple in that, yes, the lingering effects of this are going to drag on for a little while longer. Is it exactly June 30th? Who knows? But the second half of the year, we're actually going to start seeing the residual effects of a recovering economy. What does recovery mean? Recovery is just essentially positive month-over-month GDP growth. That's all it is. It doesn't have to be meteoric. It doesn't have to be 6, 8, 10% for it to be considered recovery. It's just going back the other direction. So while we are seeing some immediate effects, and I'll get to where the immediate effects are already being seen, especially in the housing market, we're not going to see that trickle-down effect into the larger pieces of the economy for another month or two, at least. But we should turn positive going into the second half of 2020, out of the second quarter. The real stickler here is, what about jobs, right? That's the big, big question. We all know what the job numbers looked like. We all know how bad that looked. So what about that? Despite these grim initial statistics, what we're looking at is that the data suggests that the Americans right now who have filed for jobless claims, now that does not mean they've been fired, whatever, they have filed for unemployment benefits. Americans that are without work right now, we're seeing statistical data that shows that they're not going to be out of work for very long. You'll see this breakdown of the Bureau of Labor, where we're looking at somewhere between 80 and 90%, 85 and 90% of these jobs are going to come back. That number is the highest number there for temporary job loss at 90%, 10% being permanent job loss. And I'll get to the reason why there. You're seeing that highest unemployment rate in what they classify as teenagers, which that makes sense, does it not? Those are the first jobs that are going to be clipped because more often than not, they're disposable jobs in the first place. Not that they're disposable themselves, but because those are the jobs that got hit the hardest. They're restaurant workers, they're, pool boys, what camp counselors, You take that cohort of people that work in service retail industries. There's a lot of teenagers that are in that group. So yes, that cohort got hit hard, but it was because a lot of those businesses were directly affected and those people just had no place to do business at that point in time. So, the shop clerk or the maintenance guy or the pool, the person in line at McDonald's, all of a sudden your productivity drops to 50% of its optimal output. Essential staff is all that's left, right? So that's how these numbers break down. You're looking at roughly 13% of these claims have been made by adult males, about 15.5% made by adult females, and then over 30% of these jobless claims have been made by teenagers. When you start to look at the numbers, things start to make sense. And so what's that breakdown of who lost jobs where? Well, we're looking at the big red line, and that's servers and bartenders. That is 100% the hardest hit industry. And now, does that look different coming back? Yes, it's going to look different coming back because right now you've got 50% occupancy here in the state of South Carolina. You've got other states that they might be gone for a while. I don't know if you guys are familiar with, but David Chang, who owns the Momofuku brand of restaurants, Momofuku, he's closing the flagship restaurant of his brand. The underlying problem there is that he's just lost almost 3 months worth of revenue, and he just literally can't, with the high profile real estate that his restaurant occupies, he had to consolidate. Now it's going to come back in a smaller platform in a different location, but the place that it currently does business is just not sustainable. So a lot of people, especially in the food and beverage industry and the hospitality industry, are going to have to look at and relook at how they do their jobs and how those jobs look. You can think about all these hotels in Las Vegas with the pool parties and all that stuff. What is that going to look like a year from now, 2 years from now, with 7,000 people in a 4,000 square foot space, right? I don't know. I don't have a crystal ball, but I know that some of this is going to have to change. We got to get out. We've got to get on top of this. We have to be Americans and go and move forward because life is just risky, but things are going to look different. And so really, when you look at it, over half of these jobless claims, when you look, are retail and hospitality. So that's servers, bartenders, retail, and then the hotel industry. Those jobs are coming back. They're not all coming back today. And you've got temp services. Now, temp services, you might actually see a spike in openings for temporary service industries here coming in the future. I'm pretty sure that the way that what I just talked about how business owners are going to have to relook at how their models are, I think that you might actually see an increase in demand for contracted, short-term, one-off employees now and going into the future. Some sort of specialist person for hire, whatever that specialty may be, I do believe that you're going to see an uptick in temporary services. That way, businesses are going to probably get a little bit lighter. The ones that need to, they're going to get a little bit more adaptive. And as a result of that, you might see an increase in temporary services. The big piece here, construction. This is the one that really pertains to us right now. Now, data that's not specifically on here, but I'll pull this up for you later. This does come from the Department of Labor. So right now, there are currently, in order to meet the demand for current housing needs across the country, the construction industry needs to add somewhere around 300,000 jobs in order to get to capacity, to where it needs to be in terms of a labor force. That's a striking number to me, considering the fact that what you're looking at right over here, 4.8% of the breakdown of the labor statistics, the unemployment reporting, only 4.8% of the jobs that had been lost and people had filed for unemployment claims came out of the construction industry. And the reasoning behind that is because of only about 4.8% of the home building population were locked down and unable to participate in their industry as of right now. I mean, there were certain states in which those activities could not happen. You guys have seen around here. Have you guys seen any slowdown of hammers hammering and cranes craning and diggers digging? Nope. And the funny thing is we still need more of those construction jobs. I think you might find that a lot of people, I'm here to tell you, construction might not be clean or easy, but it does not pay poorly. It does not. I think that you might see some of the breakdown of the way that the labor force is pile into construction because there's a need, two, it's lucrative, and three, there's a fairly low barrier to entry for many construction jobs. You've got a lot of these people that are without work. If they're resourceful, they're going to see that need and fill the need for both them and for the industry by jumping into construction. Like really right now is a time where if you know people, or even if in the conversations that we're having with people, if anybody knows anybody that's struggling or whatever, it's not a bad idea to start having some conversations with some of our constructors, contractors, plumbers, electricians, home builder friends. Start creating those relationships and seeing if they need extra bodies to help out. It might be an opportunity for you to help somebody, but also to create a relationship that could be lucrative for you going down the road. That's a big deal with us, having construction be the backbone of this recovery. A lot of it starts with having the people there necessary that are needed in order to do the jobs to fill the demand that we've got. And the final thing is childcare workers. Those jobs are coming back pretty quick because I can guarantee you that I know of at least 2 people on this phone call that would pay whatever they want them to have. Take it. I can't do it anymore. Take it. I don't need this thing here at my house any longer. Childcare workers are going to get back to work. Now, does it look the same as it looked 6 months ago? I don't know. But all I do know is that there is going to be a need immediately for childcare services. The more and more businesses that open up, those services are going to be necessary. Not just wanted, they're going to be necessary. So those are really 4 pieces of the economy, and I don't know how long it's going to take for that retail hospitality piece to put itself back together, but it's already starting to. And if, for example, the way that the numbers work right now, we are looking at, yes, a graduated recovery. So it doesn't mean that it's going to be just lightning bolt right back up to the top. But the way that the pieces of the economy break down, and the way that the need for these essential services breaks down, we're looking at climbing back up. And so what has that done? We've gone wide economy, job market. That stuff is good information for us to all have. Now here's where we turn it into what it's looking like for the real estate market right now, what it's done. You would not be surprised to note that right here, looking at that number right around the second week of March through to the second week of April, basically March 12th to April 12th is when we slid down the slide, right? Look at that change of real estate showings. You had almost an 80%, almost 90% drop from where that level was. But it's really funny, the last 4 weeks, we've gone almost back up to a baseline where we were at the beginning of January. That's pretty remarkable considering the fact that we basically haven't been able to show properties or have open houses. I mean, you see this gap right here. This was no open house time. Everything went down to the bottom. Nobody riding in your car. We were literally turned off. And in 4 weeks, we've returned to the same level that we were at the beginning of the year, based on real estate showings. And based on current pent-up buyer demand, I'll share another slide with you, but it's not included here. But if you base current buyer demand right now, it is at a level that is still requisite to 2013. I think that's pretty remarkable. And you look at this, I don't know a whole lot about much, but I do know that the nature of business is supply and demand. That determines price. The metric of supply and demand determines price. Now, 96 metros in the United States had higher median existing single-family home sales prices compared to 1 year ago at this time. Look at all those bubbles in South Carolina. Can you find me Greenville? Yep, you're right. It's the dark red one. Home prices are still going up. Demand for homes is still high. Our inventory is still low. High demand, low supply. Housing is still stable right now from a fundamental standpoint of supply demand. So what does it look like in terms of the real statistics? Okay, you guys are going to see this. This is from GJR. I'll send this to you. They do every month. If you guys don't already know, every single month there is a new report that comes out, and you can get a little bit more finite, and I'll show you about that in just a few seconds. But I wanted to really hit on this overview. While it's not neighborhood specific, yet price point specific, whatever. Across our Greenville market, there's a few really telling figures here. New listings month to date from year over year, from April 2019 to 2020, you're looking at almost a 20% drop, a 17.6% drop in April. Year to date, we're only down 3%. So that means that listings up until that point were trending in the proper direction, right? Now, pending sales, here's the big thing. This is the lagging indicator of the fact that we just haven't had a whole lot of property to show, and you couldn't even get in the car and ride around and go see it. Pending sales had dropped 59%. Well, what does that mean? That means that really right now, that's a lag for the last month, that March to April, middle of April, when people just really couldn't get out there and do it. Everybody was joggling, justling. Now, this is market-wide. This is not our office-specific wide, but our office number looks almost exactly like that. Pendings are down about 50%, about half. So you're saying that we basically got told not to do our job, and we still did half of it. I mean, this is quite literally, is the glass half full or is the glass half empty right there? Closed transactions. Now, granted, the closed transactions were in process before the lockdown took place, but even still, you've got a little bit of piece in here that you can account for that. We're only down 12% in closed transactions. As a result of that, you've got an average sales price that has gone up 3.8% year over year, April of last year to April of this year. You've also got a list to sold price that's gone up to 98.4%. Maybe we're just getting a little bit better price in our listings. That might be what it is, but it's also not a bad thing. We're not seeing everything go on sale right now. No one's cutting prices. So that list to sold price ratio has actually gone up. And another good thing that you can see here, while you see inventory of homes for sale, that number has increased 22% year over year. So from April of 2019 to April of 2020, we have 22% more homes on the market right now for sale. You might think, oh gosh, nobody's buying this. This doesn't mean a good thing. Nope. Au contraire, days on market has dropped 5% year over year. And still with that, the final figure on there, 4.1 months of inventory. Yes, it's gone up 20%. It needs to go up another 20%. 6 months of inventory is the benchmark healthy figure for a balanced real estate market. We are still in a seller's market. But the funny thing is that even in a seller's market, prices are going up, percent of list to sold is going up, and your days on market's going down. I think that's a truly remarkable figure. I really think that's fascinating. I really, really, truly do. So,
hey, Richard, I got a question on that. Would you say that 22% increase could be attributed to a lot of the new builds we've got coming on in our area?
Yes.
Okay.
I absolutely do. I absolutely do. And one of the things is that for about a year we had not a problem, but there was a lack of skilled workforce to be able to produce the amount of new housing starts that we needed to. You had contractors and construction workers that they couldn't find enough people to get things done in time. So now we have a little lag of introduced homes into the marketplace that have been in works for a year and a half. I mean, you're looking at 10 different developments around downtown that are just small residential single family homes. That's 300-ish rooftops that we've been waiting on for Lord knows how long.
Long time, yeah.
Yes. So 100%, yes, I do think that that's attributed to a lot of the new construction. On the flip side of that, I still think we need a lot more new construction.
Yeah. Because
it's still there. The demand is still there, and it's not going anywhere anytime soon. So,
thank you.
Yeah. Bottom line, you really, it's right now is the time to just fill your head with as much factual information as possible so we can answer the questions that are on everybody's mind right now. And I'll send you the links for these, but just really so everybody can know, I'm going to show you, I'm going to back out of here and I'm going to show you guys what I'm looking at. So number one, here's the first place that you can go. Can everybody see this all right? Just wanted to make sure. Okay. First website to go to, screaltors.org/market reports. And you'll see here that you can search, you can either search in your selected area. If you want to click on GGAR, that will pop you out here. Just within here, you can search by area. So you can get area specific market data. I'm just going to randomly select 71.
Richard, I think we're still seeing your deck.
Really?
Yeah, we're on Be the Knowledge Agent.
Isn't that interesting? Interesting.
You have to select the screen to share.
Oh, that's what it is. Now we're talking. My fault. Okay, here we are. All right. So we're at now can everybody see this? Okay, good. Okay, we're at screaltors.org/market reports. And so what we do is select on, I mean, you can do Western Upstate, you can do Greater Greenville, but you can see here, it'll pop out for each of the specific areas that are available in GGAR. So if you want to do that, you can do that. You can also do regional data sheets. You can do annual housing supply. There's a lot of great stuff here on screaltors.org/market reports. So you'll see here, like for example, this is the local market update for just area 71. You'll see here again, down a little bit on new listings and closed sales, up. Median sales price, the numbers are roughly the same as they are market wide. And then you'll have just that more specific data. So if you've got somebody that's in that really wants to hone in on their neighborhood, you can make and tailor that data specifically to the area that you're looking for. Here's like what I said, here's the larger report, and I'll share this with you as well, but this is the month of April for all of GGAR. It's not just area specific. A third piece for you guys to really look at, I hammer this, but Keeping Current Matters is a great resource for information. You can see that some of this stuff probably looks a little familiar because I used it on the presentation this morning. It's good information, but it's also tailored not just for me to be able to come in here and give you guys good graphical representation of what's going on. It's for you, the agent, to be able to share with the consumer. It's helpful for me to show you guys how to get to it and how to utilize the tool, but that information is really for you, the agent, to be able to share with the people that we're working with. I'm sure everybody's probably seen this slide, and it's a comparison analytic of the Great Recession, the Great Depression, and then also JP Morgan and Goldman Sachs projections for what's going to happen this time around. It's simple, it's clean, and it's also factual data that you can use in a shareable format. Keeping Current Matters. The next bit for you guys to take a look at. So NAR, that's what we've talked about before. NAR, you go to nar.realtor and you'll click on Research and Statistics. You'll see here, it will take you to Research and Statistics. From the main page of that, you'll be able to see research reports, but the easiest way to get to everything is to come down here to the Economic Pulse, weekly numbers, and then the economic survey, the flash survey. These are all good. These are all good options, but here you can see all of the statistics that you can utilize, and they do update these every week, both from a housing statistics perspective and from an economic survey, which essentially just gauges the opinions of consumers in the marketplace, their likelihood to sell, list, what their thoughts are on sales price, their likelihood of moving forward the way that they wanted to, et cetera, et cetera. You can see here this weekly housing market monitor. It goes through several different things pertaining to this week. They talked about volunteering, donating to nonprofits, and then also too, they surveyed several buyers in the marketplace. You can see, while this is a great statistic and a graphical representation of which, you can see that new listings and pending sales, while they dunked about 30 to 40% at a point, nationwide, we are coming back already. And you can see this is by a daily basis. This is not these are not weekly tick marks. This is day to day. So from a month ago, we're down about 5% as to where we were a month ago. You can see metropolitan area statistics. This is where that 96% of metro areas had higher median existing family home prices compared to last year, et cetera, et cetera. The Economic Pulse survey it has a lot more of information about tenants paying rent, mortgage forbearance. Interestingly enough, across the board, 75% of realtors surveyed said that they had not spoken with a client about mortgage forbearance or anything related to that. So I thought that was pretty interesting that despite all of the hubbub about this, we're talking about 1/4 of the population really is in a funky position. And why? Quite honestly, it's because Americans have a larger equity share in their homes than they ever have before. And because prices are moving in a healthy manner, they're moving moderately up and forward. And also too, you have, honestly, you've got loan values that are at historic lows, low mortgage rates, but you've also got an extremely low tolerance for poor or negligible credit reporting. It's 6 times harder to get a loan than it was 15 years ago before the crash. It really is. I mean, you could walk in there with a pulse and get a loan. I mean, you could have somebody write in crayon on there, I owe you, and you could get a $300,000 mortgage. Good rates, low mortgage availability, good pricing. That's why you're seeing people in a better position just from a home ownership perspective than they were 10 or 15 years ago. So even if they want to stay put, they're in a better spot. But if they want to move, they're also in a better spot, both from the equity that people have built in their homes, but for the fact that if you wanted to purchase right now, you're at a historically low mortgage level rate. That being said, it's not all sunshine and lollipops. And I think that, while I can talk through the positive side of everything, it's because I exhaustively researched these numbers. And so there are people that are having difficult times, but it's at this point in time right now, I know I wrote on there, be the knowledge broker. This is the time to really dive in and overwhelm yourself with statistical data that's pertinent to the public. I mean, that's our job, is to protect the public. If we do nothing else, that's protecting the public right there. And people are going to appreciate that. Whether you get a bunch of new clients, that's not the name of the game right now. We're still in the human phase. I don't care what people think about rah, rah, boom, 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 boom. We got to do the right thing right now. Yes, we still have a job to do. And for the people that need our help, it behooves us to have the most information at our fingertips so that we can be the voice of reason and a voice of knowledge. Because reason and knowledge right now is going to help create trust, and it's going to pay us back when it's time to move forward. So it's not about pumping the brakes. It's not about mashing on the gas. It's about driving the speed limit. I've said it before. I'll say it again until everybody's sick of hearing me say it. Guys, any questions? All right.
Nope, that was good. Thank you, Richard.
Thank y'all. Y'all have a great weekend, and I will talk to you soon. Thanks.
Bye, guys.